Welcome everyone. My name is Kamal Manocha. I represent PMS AIF World. Today we have Mr. Aniruddha Sarkar from Quest Investment Advisors to discuss about topmost question which is there in everyone's minds today, that at 18,200 levels of Nifty we are kind of back to all-time highs, closer to all-time highs. The last all-time high seen around 1 year ago was around 18,600, so we are back to that level already. Now from here, where is it that we are kind of expecting markets to go ahead? So what is it that can happen maybe over next 1 year, 2 year, 3 year, 5 year is something that we are going to discuss, and we are going to discuss that more minutely in the context that over last 12 months we have seen that on one side China has fallen by almost 35-37%. It has shown some recovery, but the numbers are kind of very deep. The PEs have come down to single digits. The Nasdaq has fallen by 30%, and Dow Jones, S&P 500 have fallen almost 18 to 20%. But at the same time, Indian markets have outperformed. As I said, we are close to our all-time highs. So what does this convey? This is also the aspect that we would want to understand. Though there is this fair, I would say, insight that all of us kind of have over years, that those stocks or those businesses which in falling markets relatively outperform, they become leaders of the next bull run. So applying this wisdom on this larger picture conveys that India, which is relatively outperforming stock in the falling market, could be the leader of next bull run. But is that so? Or what are the views that our speaker has regarding this? This is also something that we will cover today. So without taking much time, I would kind of start the discussion with Aniruddha. Welcome, Aniruddha, for this one-on-one conversation
Yeah,
regarding
thanks,
this.
Kamal, for having me here.
It's our pleasure, Aniruddha. So foremost, I want to understand from you, what are your top thoughts on what are the headwinds that we have in terms of the macros risks, which are in front of India, given the rise in interest rates worldwide, and then what are the kind of tailwinds which everybody is hopeful about in terms of attractive micros. So what is the reality about these two aspects? Let's start from covering this perspective first.
Sure, absolutely. And a warm welcome to all the investors who are at this point of time their life, and also who will be watching this video subsequently on different channels. So if you look back in the last 1 year, I think, as you rightly mentioned, last year, sometime in October, we were at all-time highs. And it seems in 1 year, we have come back to the same point. But if you see this entire 1 year, there have been so many events. We have practically had everything you could think of, and also which you could not think of, the Ukraine-Russia war. You had the Fed hikes happening, almost like 400 bips hikes happening. You had inflation being at a 40-50 year high. You had food prices going up over the roof, oil prices going above to $130-$140. You had Ukraine-Russia war, which was something which was unthinkable. So all these things, I would say, is something 1 year back, if you would have picked up any of the interviews, nobody would have given you an outlook that these things will happen in the next 1 year. But I think one thing which this proves is that all these events, they get amplified in the shorter period. Like if you see the way the markets reacted in, say, last year, October, November, December, and even January, when the US interest rate hikes were happening, and the type of FI outflow which happened, that led to sharp correction in so many stocks and indices. It was I would say, a period of fear and panic that got amplified in the month of Feb, post Feb, March, April, May, wherein because of the Ukraine war, it seemed that the world is coming to an end. I think there were no shortage of interviews of experts across the Wall Street who were kind of giving the next doomsday is coming, and the next world war is here. And definitely that also goes down to investors, because ultimately investors are the humans, and you tend to panic and exit all those good stocks which are holding for ages. And so these events get amplified in the shorter duration. Now if you see this 1 year period, we have passed through everything and you have come back to the same level where you were last year in October. Now I would say where we stand today, most of the headwinds which were there for the last 1 year is all priced in. Two major headwinds, one being the US interest rate hikes, and second was the inflation. I think inflation, we have been saying for some time that definitely before the end of this year, it will peak out. because we saw the inflation picking up from last year, August, September. So the base effect will come into place, and definitely you will find that, peaking out of the inflation, not just domestically, but also internationally. Yesterday, in fact, the US inflation was slightly below estimations, below expectations, but I would not pay too much attention to it, because I would say it was an overreaction on the market to go up like 1,200 points. Because if you look at the inflation number, it still remains way, way above the comfortable zone, which the US Fed wants. So I would say, yes, we have peaked out, but yes, it's not out of the woods, but I would say it's all priced in. And from here on, if inflation comes off, you will see these bouts of massive buying, which will happen, which is the risk on mode, which is seen in the equity market. The second, I would say the first was inflation, which we're seeing peaking out. Second headwind, which was there, was the US Fed hike. I think we are very close to the, I would say, the interest rate target, which the Fed has. Maybe another 50, 75 bips could be there, but we are practically very close to those levels where the US Fed wants the interest rates to be there. Domestically, I don't see the interest rates going up drastically. Yes, there could be some kind of the rate hikes where the banks could be looking at transferring some of the rate hikes, and that could attract some of the money towards FD. But I do not see domestically the rate hikes happening beyond, say, another 50 bips on the maximum. Only I would say the uncertainty or the headwind which remains as of today, which I would say is the known headwind, is the where the Ukraine war is going to head to. But if you look at the news of yesterday, I think some parts of the Russian troops were withdrawing from some parts of Ukraine. That again gives you that comfort that I think we are not going to escalate to the extent which we were fearing just 15 days back, that there could be a major escalation of the war in Ukraine. That also seems like it's slightly behind us. So unless there is any new event, which I don't foresee happening, I would say that most of the existing news are all priced in. On the contrary, I see a lot of the tailwinds which is there, and that is where I would like to draw your attention to, and also the investors, which we have been saying for some time, that if you see the way the world has changed post 2020, there's been massive shifts in the balance of the world economy. And this was something which was not expected. Say in 2019, no one expected that these major tectonic shifts, if I talk about, would be happening in the next 24 to 36 months. Now, if you look at the way what used to happen is, prior to 2020, say from 99, 2000, when we had the IT boom, after that, the last 2 decades was all about, cheap manufacturing of the goods in China and other Asian countries, low interest rate environment, wherein we saw the low interest rate happening in all the European countries, America, etc., which were the consumers, and also the cheap capital. Now, all this led to massive consumption, which was seen in the developed markets. And also, there hasn't been any major military conflict anywhere in the world in the last 2-3 decades. So this was all the environment which was there prior to 2020. And this, I would say, was kind of a golden period for mobilization of capital and the labor and across the boundaries. And that is something which we have been seeing. And what this actually kind of continued to happen is that we saw China emerging as a major economic and a military power. And now this is something which I would say kind of peaked out with the pandemic. So I would say that with the virus coming out of Southeast Asia, that was kind of the peaking out of what this whole trend was there of labor and capital moving across the boundaries, and the goods and services moving across the boundaries. Now what we are seeing is a new kind of a different world order, wherein I would say the world has entered into an era of the higher inflation and the higher cost of capital. And I would say that, we are not going to go back to the old low inflationary environment anytime soon. It will take time, whether we talk about 12 months, 18 months. We are in an environment of the high inflation, and also the high cost of capital is again something which will be there. Now, also what this has, I would say, brought about opportunities for India is something, which we have been saying, that there's a massive opportunity which has come across for India. And that will be the tailwind which I was talking about, that the two events which I would say is giving the maximum advantage to India is, one is pandemic and second is the Russian war, wherein earlier we were talking about China plus one. Now we are talking about a new world order where India plays a dominant role, from not just being the IT services hub of the world, but also from becoming a manufacturing services hub of the world. Apart from that, I would say that more and more global economies, whether you talk about UK, EU, Australia, Japan, America, everybody wants to have a free trade agreement with India. So these are something which in the last 2 decades was something happening with Southeast Asia, which is now coming our way. So I would say that definitely we might have come back to the old highs, and investors might get very worried that, I think it's a time to book profits and, exit the market because we might fall from here. I would say most of the negatives or all these macro events which are hurting the market for the last 1 year are all priced in. Unless you see something new happening, and if you're here in the market for the next 36 to 48 months or 60 months, I would say there's a massive, massive opportunity of participating in this massive upcycle which is going to happen.
Sure. So, before moving on to the, subsequent questions that come to my mind, I would want you to kind of give us some numbers. So when you say that, massive upcycle, so if you were to kind of give your projections, say over next 6 months, it is difficult to say that, but still I would want you to kind of, face this difficulty and on camera today, and we will not, hold you for this. But still, say by June of 2023, by December of 2023, and then in 3 years and 5 years, what are the kind of levels that you see? And at the same time, also be cognizant of the fact that what is the economy size today and what is the market cap to GDP ratio? Maybe if you want to cover all these aspects in that context.
Sure. See, I'll say I wish I knew the exact index levels. As you said, it's a difficult question, and I should be answering it. But yes, I'll take my kind of the wild bets. But yes, there will be some basis to it, because if I just give you a number, it has no basis to it. 6 months, I would say, is very, very tough, because as I said, in the short run, it's very difficult to predict. But yes, from where we stand today, I would say looking at the mid single digits type of a index return. Anywhere between say 5 to 7% kind of a index return from year on in the next 2 quarters is very much kind of possible. And but if I take the liberty of talking slightly longer term, and that is where we have been trying to I would say educate investors that over the next 4 years, 5 years, and if we give you just the basis to it. So if the economy is supposed to grow from the current 3.4 trillion or 3.5 trillion to a 5 trillion economy by say 2027, so this number works out to roughly around 7.5% kind of an annualized GDP growth. Now, historically, if you see, the equity markets have given you anywhere between around 4% type of an alpha over the GDP growth rate, because equity markets are a better concentration of the top performing sectors and companies. So if the market gives, if the economy gives you a 7.5% kind of a GDP growth rate over the next 5 years, you're looking at a market giving you around 11 to 12% kind of an annualized return. So that type of a index kind of a return, I would say investors can expect. If I look at the corporate earnings, I would say that, so now this will be the broader index return, which is like a 11 to 12%. Now you filter down into the sectors and companies, and that is where I would say the big alpha creation happens, because ultimately investors are looking for alpha over the benchmark, because definitely ETF has been a decent allocation in many HNI portfolios, but I would say still in Indian context there is a scope of building alpha by actively managing portfolios. So if I, within this 11-12% of an index, if I break it down into the top performing sectors and companies, which will be growing at say anywhere between 15 to 18% kind of an annualized growth rate, you are looking at making anywhere between 15 to 20% kind of an annualized kind of a return from equity portfolio, actively managed, well allocated equity portfolio over the next 4 to 5 years. So that's a type of, I would say, the scope of opportunity which we see as we stand today.
So I do know that your forte lies in kind of generating alpha by rotating between sectors, and absolutely, I have seen your performance on in that context, and we will cover that particularly, with regards to your sector views. But broadly speaking, just doing the justice to the topic. So when we say that we are at back to all-time highs, so you are not worried in terms of what can happen over say next 12 months, because last 12 months have actually given disappointments to investors, and we were prepared for that because before that 2 years were kind of too euphoric rally, and last 1 year though investors are disappointed, but it was an expected disappointment. However, over next 6 months to 12 months, do you see that from the whatever news and information we have, obviously something comes out of the blue, and uncertainty is something nobody can project. So from the point of view of the data and information we are aware of, you believe that the whatever corrections had to happen, that phase is over, and with now maybe US also rising over last say 3-4 sessions, and then the rally that we have seen kind of today and last week also, where we are again close to all-time highs, this is going to now build up from these levels.
See, I would say that, as you mentioned rightly, last 1 year has been kind of a weak market for everyone. And I would say that was very much expected from a point of view that, the mean reversion is something which always happens in the market. And with 2020 and 2021 being supernormal years, I would say it was very much required that you get 1 year of flat to negative kind of a return, which I would say helps in doing the mean reversion in the markets. Having said that, I would say from where we stand today, uh, uh, I would say investors should not kind of look at decreasing their equity allocations, because as I mentioned, a bulk of the news which we have as of today is all priced in. Now, if you ask me that, yes, India looks expensive, and India has outperformed most world markets. In fact, earlier India used to be compared with the emerging markets, but now I think India has outperformed even the developed markets. Now that has brought India into the spotlight because valuations have become very, very expensive. If you look at India's valuation compared to the MSCI Emerging Market Index, we are at all-time high on the valuation perspective. If you look at the gap in the returns of the US market and Indian markets, I think there's a massive gap of almost 25 to 30% kind of a gap over a period of time. Now, I would say these are not unfounded numbers. It's evident in the fact on the ground. On one hand, in Europe and US, you're talking about a recession and a slowdown. You have companies who are decreasing their employees. You have attrition in all the big companies, from Facebook to you name the company, and you have having attrition there. On the contrary, what we are seeing in India is there's a debate whether India will grow at 6.5 or 7.5. So we are not talking about a degrowth here. We're talking about whether it will grow at 6.5 or a 7.5%. You talk to companies are in a capex mode, and they are like looking at putting up the capacity. Yes, I would say it's not happening to that intensity, because definitely the world is looking slightly weak at this point of time. That's why most of the promoters of various companies would have kind of put on hold to some extent their capex plans. But capex is something which is going to be a massive growth driver for India in the next couple of years. You talk to IT companies, I think last 2 quarters they have had some weakness with regard to I would say the margin compression or maybe the deal wins. But if you ask them with a 18 to 20 month horizon, I don't see them getting pessimistic about the growth opportunity. So all these outperformance of India which we have seen, or the valuation premium which we have seen for India, I would say they are all kind of indicating that this is not on the false ground. You have the numbers to support it. Now, if I just give you some basic numbers, like, the last 2 years, say FY20 to FY22. So that would be kind of the pandemic period. Now, during that period, the Nifty profits were up around 70%. Now, this is something which, goes unnoticed, that, you have the pandemic year, but the Nifty profits were actually, in absolute terms, they were up around 70%. Now, you can attribute that to the margin expansions, cost savings, and multiple kind of the growth drivers which we have seen. Now, over the next 24 months, also, if you look at the expectation, Nifty profitably growth is expected to grow at anywhere between 18 to 20%. Now, these are kind of the numbers which the market is now factoring in. The other thing is, I would say, which will keep, I would say, the valuation premium high, is the money which FIs have been taking out from India for most part of the last 18 months. We are seeing that money coming back to some extent in the last 60 days. Now, I would say this is just the beginning. More and more FI fund houses, FI institutional desks are talking about increasing their India allocation. In fact, I think so Mr. Woods, I think just today he came out that they're decreasing the weightage towards China and allocating that extra 1%, which they are decreasing from China towards India. Now, these are, I would say, those tectonic shifts which I was talking about, that, you will find a massive kind of a change in the perception towards India. Over the last 18 months, when the FI money was going out, bulk of the money was a part of an emerging market ETF, and also because of whatever events was unfolding. Now, one thing which is going to happen for India is that what Japan saw, what China saw, we will see in India. Now, what they saw was that most allocation towards Asia used to be done ex-Japan, ex-China, because there were some focused funds which used to go into those markets. So China and Japan used to be not put into that entire basket of allocation for emerging markets. Same treatment I'm seeing is going to happen for India. India is not going to find just an allocation as a part of emerging market, but you will find India focused funds coming in a big way, wherein you want to make allocation towards India as a separate economy. Now, you cannot invest here, as a separate fund, because if it's the third largest, fourth largest economy, and you put it in a bucket with, all the small economies who are emerging market, definitely you are not doing the right justice. So I think that perception change is something which is going to be a big driver. And lastly, I'll say that, what is going to continue to maintain this, I would say, premium valuations and consistency is the domestic participation. And we have been looking at the numbers, the SIP numbers. I'm sure you would have also seen that SIP number. So I think it was circulating on the WhatsApp that over the last 24 months, ever since, or almost last 36 months, even considering the pandemic, the SIP money has gone up from almost like 6,000 crore per month to 13,000 crore per month. On top of that, you have the EPFO money coming in. Now, EPFO money was a big transformation which happened a couple of years back. Initially, it started with 5% allocation, went up to 10%, and now 15%. I won't be surprised if in the next couple of years that EPFO allocation also doesn't go up to around 20 to 25%. Now, these are the different segments of the capital allocation towards equity markets, which I feel will keep the markets elevated. It's not that markets won't fall. Like, if we are talking bullish, it should not sound that, market will not come down ever. Small blips, small corrections definitely will happen. Going down from 18,400 to 17,500, yes, it's not impossible. We were just there at 17,500 a couple of weeks back. But yes, I would say broader trend remains very positive.
So having said that, and we also firmly believe into that, and that is where we have in fact been kind of running a series of webinars, and we have done events also on trying to crystal gaze this decade, because we also believe that this decade is going to be a decade for India. And in fact, we are organizing our annual event now, which is the 4th annual event, where we have kept the title of that event as the resurgence of the golden bird, which is all of us understand it's we are talking about India. So absolutely, all of us believe that it's not just an emotional statement. It's backed by a lot of hard data, and the outperformance that India has shown in terms of falling less over last 12 months obviously does dictate that there could be a possibility of India becoming the leader of next bull run whenever the world flow towards equities starts to happen again. And thank you so much for kind of I would say reassuring that belief. So now moving ahead, we have seen over last 12 months the massive correction has happened in sectors like IT and pharma, because these are the two sectors which got kind of maximum favor from the pandemic period. So do you feel if we were to talk about these two sectors particularly, is the correction done, and there are some good businesses that we have kind of understood, especially during the pandemic period in pharma as well as in IT, be it stocks like Divi's Lib Labs, or be it stocks like Dr. Lal Path Labs, right? So and likewise, there are many stocks within pharma, and especially in IT there are many companies that we have been talking about, TCS, Infosys, right, Info Edge, many such stocks. So I'm telling you, I'm stating some of the names of these stocks because many portfolios have these stocks, and many clients have standalone been holding these stocks, and they have a very high conviction. I don't think any client has sold any of these stocks, and obviously they do not have courage to add more because these stocks have seen kind of overcorrection. But now it is maybe today as a first day where we have seen some of these stocks going up and kind of some of these stocks building up because these stocks had seen massive correction. So what are your views at these levels? Would you advise investors to now jump on to adding more to these kind of businesses from these two sectors, or you still feel that this is just kind of a bear trap kind of a rally in these sectors?
See, with regard to IT and pharma, if you remember, for most part of 2020 and 2021, we also were extremely bullish. In fact, if you look at our portfolios for most part of 2020, 2021, IT and pharma collectively made around 30 to 35% of our portfolio. Where that allocation we took it down to was, I would say, around 11 to 12%. If you ask me as of today, I would say between the two, if you ask me as a broad sector wise, between IT and pharma, I see more value and opportunity in IT. I would not say to jump in at all go, but I would say that you can take your selective bets over there. But I would say that still I would wait for a couple of more months to see how this quarter also pans out, because only then we'll get the comfort that the sector is completely out of the woods. The margins are going to improve, the deal wins are happening. Because I would say that IT is one sector which definitely has its hands in Europe and America, where if you're talking about a slowdown happening there, definitely it is going to impact. And it is impacting. The new deal wins are not happening at the same pace what we were seeing earlier. And also, I would say the margins have also contracted. But yes, the valuations have come to such levels, which I would say this is not a time to sell. The time to sell has gone back. Now it is a time to gradually allocate some money towards IT if someone is heavily underweight. If someone has at least a 10-15% IT exposure, I think he can continue to hold it. But yes, I would not say this is a sector where you should go extremely overweight. It's not that we are negative on the sector, just that the valuations were not commensurate with the growth numbers which were happening. With regard to pharma, I will say you need to be very selective, very specific which pharma companies you're betting on. Now, unlike IT, I think in pharma, you have a huge spectrum of companies. I would continue to bet on companies which have a large presence in the domestic market. And I would continue to bet on companies where there are not too many of the headwinds with regard to the US FDA. The reason being that I think, we have seen in the past what happens when, the approvals don't happen for a long time. The costs keep kind of running. The margins for the US market are extremely bad. And that hurts your operations in the other markets also. So I would bet within the pharma space definitely on companies which are mostly or have a bigger chunk of their exposure to the domestic economy. And that is where I would say investors should be focusing on that. IT, yes, you can start biting into it, but pharma, be very selective.
Sure, Aniruddha. The next question that comes to my mind, if I put myself in investors' shoes, is that we have seen over last 12 months, markets have, as you said, market always, follows mean revision. And if you apply that, insight to understanding some of the stocks and businesses, so we have seen some of the popular stocks in the older era, like Asian Paints, HDFC Bank, right? So some of these stocks, and obviously within IT, Infosys, TCS, Bajaj Finance, these were very popular stocks till maybe January of 2022. Now these stocks have given either negative returns or zero returns over last 12 months. But at the same time, when we are saying equity market is back to its all-time high, there are certain other stocks like L&T, Coal India, SBI, Axis Bank, right? Some of these other stocks, Sun Pharma, ITC, which have actually outperformed. So now, from here onwards, what is your belief? Will this actually, because there are two views. I asked these questions from various fund managers. Some fund managers say that all these stocks which have actually risen over last maybe 1 year are belonging to cyclicals, and they are not the quality businesses. They are not growth focused businesses. There was a value in them, and because of mean revision, they have kind of rallied. But now they have seen the whatever best times they had to see. So we are not going to see SBI doubling from these levels. We are not going to see L&T doubling from these levels. Ultimately, it is the quality which will outshine. And maybe today, I do not know. It's the beginning of that again reversal, but I do not know. So I hence ask this question as an investor in next 12 months or 3 years, what is going to happen in this regards?
See, I'll say that, that is where, I've been educating investors over time. And I'm sure you would have also heard me in many of the meetings and, interactions that investors and portfolio managers, I think, needs to be very, very agile and flexible. So there are times when you have to adopt the value style, and there are times when you have to adopt the growth style. I would say that it's not a time right now where you completely avoid the value part and you just look at the growth part. See, I would say that, the type of movement which you would have seen in some of the growth stocks today, it was to do more with what we saw in the US market yesterday. Say the NASDAQ was up around 6%. You saw growth companies going up 10, 20, 30%. And you saw a similar kind of a reaction in some of the new age companies today, also to do with the numbers and earnings. And also because of, if you talk about HDFC twins, it was about the MSCI index, the changes which was happening. But I would say that yes, HDFC Twins, if I take HDFC Twins as kind of a benchmark for the growth part of the banking sector, and say an SBI, if I take as a representative of the value part of the banking sector, I think it's a time to continue to have both. And if you remember, almost like 18 to 24 months back, we exited HDFC Bank from our portfolio. Last 6, 7, 8 months, we have been buying into HDFC. The reason being that the valuation at which we had exited, from there it has corrected almost 30-40% on a valuation perspective. And that was the reason for us to get back into HDFC Twins almost like 6, 8 months back. And even as we speak today, I think we are quite bullish on the HDFC Twins from a valuation perspective. Will I sell my SBIs of the world? Answer is no, because I think I would not say that it's a cyclical business. I would say SBI has definitely transformed itself in the last 4 to 5 years. If you talk about its customer base, if you talk about its ROE, its ROA, and if you talk about its balance sheet, if you talk about its growth into SMEs, into the retail space, I think it is at par with anybody else. In fact, we had just conducted an analysis of how the different financial products market share is there for the different large banks. It was very interesting to note that almost in every financial product, SBI was there in the top. And it's not that it has, there was a perception that the PSUs have lost market share to the private banks over the last 6-8 years. Yes, PSUs as a bucket have lost, but SBI has been able to maintain its market share in most of the products. In fact, in some of the categories of products, they have increased their market share over this period. So I would put a bank like SBI definitely in a different bucket. So yes, I would say it's a time to kind of have both of them in the portfolio. Multiple expansion can continue to happen for both SBI and a growth bank like your HDFC Twins. There are many other banks, I would say, that in the financial space, since we're talking about the financial space, without getting into the names, many of the banks which are quoting at say 0.7, 0.8, even one-time price to book, they have been improving their numbers, their balance sheet, their ROA and ROE. And I see them as good potential candidates of getting a higher multiple on the next 18 to 24 months. And they would all again fall in the value part of the market.
Understood. I think you have answered the question very well. Absolutely. So now, the subsequent question that comes to my mind again, is more about trying to understand, the consequences of all these rate hikes that have happened. When Fed has, hiked rates, back from maintaining close to 0% rates, which were announced in during global financial crisis, and then they had raised it kind of gradually to around 1.5 2%, which were brought down to close to zero through during pandemic period. So we are back to, I think, close to 3.5%. So obviously, we know that there could be possibility of 2 3 more hikes happening, but these hikes happening now at this time, where world has seen pandemic, 3 years ago, many businesses would have already struggled. So after this, now cost of borrowing is up. So does this pose any big risks in terms of any economies going down? Or when we're talking about financial services sector, we are talking about stocks like Bajaj Finance, and we have worry of these stocks, and these stocks had fallen during pandemic period, right? And today also, the I think issue could be that the borrowing cost is so high, and hence all these banks and NBFCs may not be able to find too many customers, because ultimately the price of product has gone up, and at the same time they will find many I would say depositors who would want to deposit money and get higher interest, and hence margins are going to get kind of
Contracted.
yes. So from that point of view, this one, we have always been saying that we are bullish on financial services, and financial services is the largest sector when we talk about Nifty 50 or Nifty 500 in terms of 35 to 40% weights. Now, one is that how does this increase in interest rates actually impact financial services sectors, and why are we still bullish on financial services sectors? And secondly, because this is not particular to India, what are the risks it poses to some of the smaller economies in terms of any unexpected problems which could lead to kind of flow of money again going back to something like gold, which could again reverse the perception again back to maybe risk aversion.
See, I would say, if I take this question in two parts, one is within India and outside India. I would say outside India, definitely, I would say the risk on mode for equity is not there in a big way. Just 1 day or 2 days movement, I would say, could be just like, the dead cat bounce over there. But for those markets, I would say that, the risk of mode continues. Uh, Actually, to be honest, I have been a bit worried for the US market because, with the type of interest rate hikes happening there, the mortgage market is something which is a very, very big concern there. We have already seen some slowdown in the sales for the real estate market. I won't be surprised if you start seeing some of the defaults happening on the subprime mortgage, or even the prime mortgage to some extent. So that is one concern which I continue to have. But to be honest, it's not there in the numbers yet. It could be because of the midterm elections in the US, or it could be because of the Fed wants to increase the rate. So those numbers are not being shown as they should be. But that is a wall of concern for me, that what happens to the mortgage market considering the rates have gone up by almost 400 bips in those markets. Coming back to India, I would say that we are very, very far away from being into that zone of concern. The reason being, I would say that in India, if you look at the interest rate hikes, and if you look at the annualized income growth of the urban population. So I'll put the urban population because they are the bigger chunk of people who borrow for buying the homes. I would say the urban population had a decent income growth. If you talk about the IT sector, you talk about the financial services sector, you talk about the manufacturing sector, I would say there has been a decent income growth in the hands of consumers. On top of it, there has been a decent kind of the wealth effect. If you talk about the wealth effect, with the property prices going up, the land prices going up, equity portfolios going up, wealth effect has also been there. In fact, we have some allocation towards housing finance in our portfolio. And, when the first rate hike started happening, we were also concerned that, will this impact the borrowing? Will this impact the defaults? And, as you rightly mentioned, will the demand come off? Then the NIMs will get impacted. So what we understood is that almost like 100 bips to 150 bips hike in the interest rate will start impacting, I would say, ticket sizes which are below 50 lakhs. Ticket sizes of north of 50 lakhs, there the interest rate elasticity is much, much higher. So it's pretty inelastic, if I have to say. The demand for home loans for ticket sizes above 50 lakhs is pretty inelastic. Above 1 crore, it's very, very inelastic. So I would say that definitely we are far away from seeing that type of an environment wherein demand for borrowing goes down from the retail side. Actually, right now, what has happened is, I would say the corporate borrowing is not happening much. If you look at the loan growth of different banking sector, bulk of the loan growth is happening on the retail side and on the SME side. The large corporates are the guys who are missing from the scene. And once that comes in, I think that will be the major up trigger for the NIMs to grow and for the banking sector to grow. In fact, if you see even our finance minister, she has been pushing corporates to borrow and to do the capex. In fact, just a couple of months back, we had heard her say that, what's stopping you guys from doing the capex? What's stopping you guys from, borrowing and doing the capex? In fact, there has been instructions to the PSU banks to go after the lending. So I would say that the retail and SME continues to be very strong customers, and the large corporates are ones who are missing. Now, within financial, I will say that, we are bullish not just on the banks. We are bullish on the entire segment called financial inclusion, which includes your insurance, asset management, the retail lending, and your banks and NBFCs. So those two parts, I would say, again dominate a large part of under-penetrated market in India, which is your insurance and asset management. If you're talking about equity markets doing well, equity allocation in households going up, asset management companies are bound to do well. So I think that is another big segment which investors should keep an eye of insurance and asset management companies.
Sure. So basically, you're trying to convey that whatever the rise in interest rates is going to pose risks. They could be challenges for India, but not maybe risks for India. They could be risks for US and for other developed economies. But in Indian context, that is not the risk that one should too much worried about, because there are too many other tailwinds in terms of the possibility of managing that risks. So after this, I also want to understand the next question that comes to my mind, that apart from normal sectors like IT, pharma, financial services we have discussed, we have also discovered over the last 5 years specialty chemical sector, which turned out to be the best wealth creator over the last 5 6 years. So what are your views, first of all, over say next 3 years with regards to this sector from here onwards? And then again, the second part to this question is that any other sector that you think is something which is less discovered at present and is present in your portfolio, or you are keeping your eye on, and you would want to kind of discuss in detail about that.
See, with regard to the views on the chemical sector or the specialty chemical sector, I would say that it has definitely been kind of the big wealth creator for most investors in the last 5 years. But last 1 year, what we saw is that because of I would say the raw material prices going high, margins contracting, and also because of the supply chain disruptions which we saw, there has been some impact on their earnings growth, and most of these were at very, very high valuations. So what we basically saw is a multiple contraction happening over there. As we stand as of today, I would say valuations are not cheap, but yes, they're not expensive also what they were, say, 1 year back. So from here on, I will say the scope for multiple expansion is not there. From here on, I would say it will follow in line with the earnings growth of every company. Because any stock price, if you look at it, there are two parts to the price up move. One is multiple expansion. Second is the earnings led growth. I don't see the multiple expansion happening for the chemical sector, but yes, I'll say that the earnings led growth will continue. The guys who are growing at 18-20% will see that type of an annualized return, and the guys growing at say 10%, 15% will see that type of a kind of a annualized growth rate. With regard to undiscovered sectors, as of now, to be honest, there is no undiscovered sector. I would say that I keep saying this to investors that in the last 24 to 36 months, because of so many people getting into the market, social media, WhatsApp, and so much of awareness in the market, I think any idea which gets discovered within 1 week, practically it's known to everyone. But yes, I'll say that a couple of sectors where allocation in portfolios I see very less is one is industrials. So industrials, when I say it is not just about L&T, I will put industrials in a bucket along with defense companies. Definitely defense companies last 6 months, they have been doing exceptionally well. When I talk to my colleagues, many say that it's overvalued, it's a cyclical business. Most of the large defense players are owned by the government won't allow investors to make money. It is for the goodwill of the nation. Definitely all those are right, but I would say that if you're buying into these companies, we are seeing the transformation happening into those defense companies. And I would say yes, the margin expansion will not happen because defense companies have a fixed margin, fixed ROE businesses. On the contrary, the margins are also contracted when the volume growth happens. Government decides the margin, so the margins will also decrease. But the top line and bottom line growth is so huge that I don't see a reason that in the next 4-5 years, significant upside can be seen from these companies also. So I don't see a reason why you can't see a significant upside from these levels also for many of these defense companies. The reason being that if you look at the order book size, if you look at the type of orders which the next 4-5 years you'll be getting, and with a mandate that 50% of your defense budget has to be manufactured within the country, there are very few limited players who can execute that. And definitely this is going to be a massive, massive opportunity. Some people have it. Some people would have exited it seeing the massive rally, but I would say there is a huge scope of opportunity within the defense basket. And now with many private companies also entering into the defense fray, I would say that at this point of time, those companies will have defense as a very small percentage in their overall top line. But over the years, as things evolve, I would say this single digit allocation of defense in their overall top line will have a 15 to 20% kind of an allocation in their overall top line. And that's the opportunity which I would say investors should hold on to. Industrials, I would say I'm bullish because for the very fact that if you're talking about India becoming a manufacturing hub, if you're talking about more and more capex, these are the companies, industrial companies, who will help this capex to happen. And that is where I would say that this is again an opportunity to be there. And this is not an undiscovered space, but yes, I would say it is definitely an underallocated space in investors' portfolio.
Sure. So, what are the views regarding agriculture and rural India? Because that is another area which has seen its contribution to GDP at some point of time high and then falling, and then pandemic had impacted this particular sector badly. Maybe it was impacted mostly. So at this juncture, the stocks and businesses which cater to this sector have seen some euphoria over last 6 8 months. But from here onwards, over say next 3 years, what are your views with regards to this particular sector?
See, we have been, in fact, we have some allocation in our portfolios also towards the agri economy picking up. But definitely, it's not one of those fancy sectors, if I talk about, wherein that, you can see a massive multiplier. But yes, I will say that this whole agri side of the economy is something which over the last couple of years has not done well. Government was focusing on doubling the farmers' income. That did not happen because of the pandemic. It got impacted on the negative. But now what we are seeing is that because of food price inflation, because of government subsidies towards fertilizers going up, and also because of election 2024 being there ahead, I think you'll see a large part of the capex from the government happening in that part of the economy, which will be the small towns and the villages. You will find your infra spends happening in those parts, which will lead to your more household income happening over there. Along with that, I'll say the monsoon this year has been much better than expected. Definitely, it has not been a uniform monsoon. Different parts of the country has got different kind of a percentage monsoon. North has got slightly less compared to the rest of the India. But yes, on an overall basis, it has been pretty good. We'll have to see how the harvest season happens. Our expectation is that post-harvest season, you should again see a pickup in the consumption of the from the agri side. So over the next 1 year, 2 years, we are quite hopeful that this is one part of the economy which will do well, with the food price inflation being high, elevated level. And that's what I mentioned initially, that the world is going to be there in a high inflation zone for some time. We are not going to go back to those old, the low single digit inflation anytime soon. So I think food price will remain elevated. Wheat, if it's not going to get supplied from Ukraine, definitely wheat prices and all other food prices will remain elevated for some time. So this translates to a higher household income in the hands of the agri people.
Sure. So coming to the last question of this episode, we have seen a period like pandemic where all of us got locked inside. And then, after that, over last 6 8 months, particularly in this financial year, what I have noticed that everybody is wanting to go out for holidays. I'm sure, you would have also planned. And we are in this quarter where most of us in financial services plan our maybe, mandatory leaves, or we go out for our offsites. All happens. Broadly, what I'm trying to convey, that what we have been noticing during our business trips also, that the flight prices have kind of gone more than 2 times. Hotel prices have also gone up. But I do not see too much allocation to this sector in any of the portfolios. And I do feel that pandemic has taught a very real lesson to various people, that one should not just save, one should spend. And this is the luxury part of spending. And obviously spending on travel is something which Indians are learning. Maybe West has more budgets for this, but obviously in the pocket of Indians is not small. If they start to spend and start to make it, you can say, obviously it's a discretionary spend, but if it becomes like a known spending every year, then it could become a business or maybe a sector which becomes attractive. So what are your views in this regards, and any stocks or any businesses that you want to talk about. And before you kind of answer this question, I would also like to give this disclaimer to all the viewers that we have been discussing about certain stocks and certain businesses, and maybe Aniruddha would have given certain positive perspective about certain stocks and businesses. Please do not construe this as any kind of an advice. It's just as an example that we are discussing these businesses, because all of us are here with an objective of learning and with the objective of understanding to ultimately make well-informed investment decisions, and where we do either our own analysis or rely on any SEBI registered analytics. So kindly be cognizant of that. Over to you, Aniruddha, for this question.
See, I'll say that this whole concept of going out and traveling and the holiday part, I would say that earlier the hotels used to look out for the travelers coming from overseas, and because they were the ones who used to spend a lot, and the price differential was also there with regard to the hotel rooms, etc. Now, what has been seen in the last couple of years that as you mentioned rightly, Indians have learned that you need to spend. And to be honest, if you look at the hotel room rates, they are almost like up 100% compared to pre-pandemic. But if you look at the rooms, they are not available. During the peak season, they're all booked. Even off season, if you look at, sometimes we wonder that, it's off season, the hotel room prices should come off. But prices are at the same level what it was even during the peak season, with maybe slight 5% here and there differential. So I will say that this is definitely a large opportunity. And to be honest, one of the themes also which we like, which we have been allocating in our portfolio over the last couple of the quarters is consumption. And when I say consumption, it is not about the consumer staples, but more of the discretionary consumption. And that is where I would say the spending has been happening, and it's going to be very strong. And this again bodes well from the fact that we are looking at everything that is happening within the country, whether it's talking about the job data being good, we're talking about the income growth being good, both in the urban side and on the rural side, and also that translating to travel and tourism. Within travel and tourism, definitely you don't have many options. You practically can invest into hotels. Also within the hotels, you have a couple of names only. Airlines, you don't have too many options, but I would say that we would not be betting too much on the airline space. It would be more of, I would say anything to do with discretionary spending where, things like international oil prices, etc., don't come into the picture. But yes, I will say the hotels, the malls, many apparel companies, these are the good places, or even I would say, some of the garment companies which are into the high end of the garment. These are all, I would say, good areas where allocation can be made. Now, in this, I'll just make I would say investors should keep an eye is that the valuation, because, some of these companies, they are at very, very high valuation. And question comes that, is a 60p right or a 70p right? I would say within that, be very careful. What is the growth happening? Because if you're paying a PEG ratio of anything more than 4 times, I think, you're getting into a very, very dangerous zone. That, wherein that it might look good right now because growth is happening, but even just 1 quarter miss of the growth will see the multiples contracting. So consumption is a good idea to be there. But when you mentioned that, there are not many investors who are invested there, because I would say many would be having a concern with the valuations, which we also had, when we were looking at the consumption basket, we had to look through, so many companies to find something which matched both value and the growth. And I would say it's a good area to be, but options of good value companies are very, very less.
Right, Aniruddha. So I will just take one question, from the, audience. And this is a good question, which is with regards to the shoe industry. This is the last question.
With regard to the
shoes industry, shoes.
Okay.
Right. So we have seen, many investors, analysts, articles, and fund managers trying to kind of, correlate the possible potential growth in the shoe industry, in stocks like Campus, Relaxo, and relating that to some of the older stories in the innerwear industry, like Page Industries kind of did very well. So from that point of view, what are your views, in this regards? And then maybe, we'll wind this up with concluding remarks. But before we end, and since we have been discussing all larger sectors, and we have tried to discuss something about some of the upcoming and new and maybe low weight sectors. So this is another sector which I have been seeing, which had stocks like Bata, which was a popular stock in the older era, And then in the recent past, we have seen stocks like Metro Shoes, then Relaxo footwear in between, which have become popular. And many investors have been investing in some of these stocks, seeing some special situations also. So we are not getting into that. We are basically wanting you to give us perspective as a larger picture, and then any thoughts, which are there, which are good or negative in this industry.
See, to be honest, I'll say that, I would not be able to give you much inputs into it because I have averted this entire space completely. And the reason is there in front of you. If you look at the multiples of any of these shoe company, they are all running at 60, 70, 80p. And see, at some point we can say that, India is migrating from the unorganized to the organized sector on the shoes and the chappals. You are going to move from the unbranded to the branded. But beyond the point of time, that scope of growth also comes off. And then, your 70, 80, 100p does not justify. So I would say that is one space which will not be in my pecking order when I'm talking about consumption. Because there, I would say the multiples are not justified. And we have seen many of the companies, the names which you have taken without taking specific names, they have seen, I would say, decent correction in the last 6 to 12 months. Massive correction has happened. Now that correction has happened not because they have not grown, their earnings are growing, but just because they are not growing at that same rate at what the expectations was. So they have seen a massive multiple contraction. And to be honest, even after the multiple contraction, they are trading at 70, 80p. So I would be, to be honest, as an investor, I would be away.
Sure. So, many do say that they are trading at high PE because these companies have created some kind of brand image, and that gives them perpetual possibility of getting their earnings discounted today. So from that point of view, whatever we have seen in terms of older brands which have seen high multiples remaining for long, like it was Titan or it was Page Industries, same thing, same possibilities are there with some of these shoe businesses. But obviously, we really value your views, and I understand that yes, if valuations are high, and one needs to be cautious. So we're coming to the end of this episode. I would just like to thank all the viewers for joining us today, and I would like to reassure that throughout, I can tell you one thing, that political, maybe countries are led by political leaders, but economies and businesses are led by non-political leaders who are aware of how to handle an economic situation, how to handle a business situation. It may take some time, but ultimately, because of the right intent and because of the focus, this does get handled. And over last 12, 18 months, whatever we have seen is happening in terms of Fed rate hikes, where we've gone back from 0 to 3.5%. Maybe, when the focus of economists will go back to growth, it will again go actually back to something close to maybe 1% or 2%. And hence, one just needs to be patient and needs to be positive. There is always an opportunity in the challenge. Today, we do see that markets are back to our all-time highs, but in terms of valuations, in terms of forward P or trailing P, we are not at all-time high. We are much lower to the earlier numbers. And I think from the last high valuation that we saw, the current trading or forward P valuations are far, far lower. And then I can also tell you, valuations is all about perceptions also. If we can see stocks like Titan, Page Industries, Asian Paints, Bajaj Finance enjoying valuations which are unthinkable, and maybe India today, if it is a bright spot, can also enjoy such high valuations because it is definitely a relative context. So from that point of view, be cognizant of valuations, be cognizant of the businesses you are entering into. However, over last 12 to 16 months, the kind of wait period we have seen has kind of made markets all the more attractive in terms of valuations, because it is a known understanding that equity markets will not be under kind of a negative zone for a period longer than 18, 19 months. I have not seen, at least in my career over last 2 decades, that markets do not make a new all-time high in maybe 18 to 24 months. We've already seen 16, 17 months into it. So this is a time for investors to be maybe greedy if they are fearful, and remember what Warren Buffett has been kind of saying based on his years of experience. So on this positive note, especially today, because we are again at all-time high, close to all-time highs, and we have seen market going up almost 2%, I would like to end this and again thank Aniruddha for sparing your time. And thank you everyone for
Yeah,
joining
thank
us.
you, everyone.